And good day. This is the Eye of the Storm podcast with the big picture technical update for the S&P 500 and the NASDAQ 100, and being recorded on Sunday, October the 8th. I'm going to start here with the SPX, actually, so let me change my chart. And by starting by saying that Friday was an incredible turnaround in the market. In fact, I found it very astounding that the market turned and what they based it on and what they put underneath all of that. The employment figures that came out, the employment situation that came out, it did show a robust hiring. In other words, there were a lot more people finding jobs. And so the employment rate, of course, declined a little bit, but more people going back to work. By no means is it deflationary. Is it going to bring down the inflation? The wage inflation will add to the Fed's necessity or need or desire to raise the interest rates come the end of the month, which is their next meeting. And as a response out of that, we saw the bond market. So we saw the Treasuries take an immediate nosedive, although they did recover along with the equity markets. So the equity markets as well took a serious nosedive upon when they released those numbers and reached their low for the day shortly thereafter. Once the market opened, it went down, gave a little bit of a retest, but then turned and then did not stop the rally or even turn to look back to see is anybody else coming in or whatever the situation may have been. So what I've done is that initially I was thinking, wow, and how I was counting the market, how I was counting both the SPX and the ES and the NDX, was that we were dropping still within an intermediate first wave, but we were inside what I was feeling should have been a continuation and then marking the completion point for a minor third wave of that intermediate first wave. Now, I have discussed previously that my feelings were that what may come about was that I may have to up my degree in terms of where I was marking minor wave 1 and minor wave 2. I may have to up those a degree to include intermediate wave 1 and intermediate wave 2. And the reason behind that was what my expectations were for this primary C wave. If labeling it as I was would have suggested that we truly are going to drop way below levels that I did not believe would coincide with a primary C wave down or the low for a cycle A wave, which is what I'm counting, which is what I'm looking for. So let me just go and review very quickly what that big picture remains and what it looks like for me. Again, in the SPX, we have the all-time high so far, the all-time high as at 48.18, and that was back in January of 2022. And that level, in my view, completed a super cycle wave 3. Now, that super cycle wave 3 began in 1932 off the low for the SPX, which was $4.41. So this, in case in point, is that this particular correction, which is a super cycle wave 4 within the SPX, remains to be a super cycle fourth wave. Now, what is that going to consist of? It's going to consist of 3 waves, an ABC of cycle degree. So we just got to work our way down as to where are we within this whole bigger picture. So we are within that cycle wave A going down. And what will it consist of? 3 waves labeled ABC of primary degree. So that's where we're sitting. We've completed primary A, and that was the October low, October 2022 low. we completed the primary B wave, and that was at the end of July, almost August 1st highs in 2023. So from that level, we've been involved in unfolding within a primary C wave down. What will that primary C wave consist of? 5 waves of intermediate degree. Now, the switch and how the degree of the labeling that I'm applying, that is not necessarily a major change, but it's an important change. Because what it puts us inside of now is an intermediate third wave versus a minor third wave. So let's just kind of dig a little bit deeper. So on the weekly chart, you can see everything remains the same. And so if we're looking at the supercycle wave 4, we have this for the entire supercycle third wave, a pullback would reach 0.382%, right? So the retracement would be 38% at 2980 in the SPX, 2980. So 90 years of bull market, 90 years of an up market, which encompasses a lot, a world war, the Korean War, the Vietnam War, several recessions, the end of a depression, right? So which lasted actually through, but that low in 1932 marked a low for the market, which then battled to get its way back out of that recession, or excuse me, depression. Now, so many things have happened in there. Inflation, deflation, recessions, etc. But that rally continued all the way up to 2022. Now, what we're looking at is a prolonged several years of a corrective wave 4. We are now in the primary C wave, which should put in the low of the very first leg down on a cycle level, cycle wave A. So I begin to look at where can this primary C wave come in? Well, primary C would be equal to primary A at 3258, I'm going to call it. 3258 was where they would be equal. Now, as I begin to formulate coming down in this level, right, because here we are counting for the intermediate third, and then we have here the primary C. So primary wave C would be 0.618 of primary wave A at 3765. Intermediate wave 3 would be equal to 2.618 of intermediate wave 1 at 3830. So we've now built a nice little cluster where intermediate wave 3 could be complete. Remember, wave C, primary wave C, would be equal to primary wave A, which is actually the most common, at 3260. How am I going to get down there? Well, I've got intermediate wave 3, we do a 4, then we do a 5. So this zone, again, 3260 to 2980, looking pretty good in terms of that's where the market is likely headed. Now, when and how long is that going to take? Well, a lot of people would want to consider that a crash. For the market down there, the market's going to crash. No, I don't believe that that's what's going to happen. The market's going to give up a percentage of the gain that it did. The market's going to give up all of this gain that it did. But in terms of crashing, no, crashing means it's just we're dropping and dropping and dropping and dropping and dropping, and things are just, the situation gets worse and worse and worse. And right now, when we can add into everything that's sitting behind what is happening, right? So right now we have a Fed. We have a Fed that's trying to deal with inflation. We have a Fed that is trying to rein that in. So that's their primary goal. But behind all of that, we have so many things working. So we now into what's going to create the market to continue to decline from here. And I'm going to call it a decline versus a market crash. It may feel like a crash, but then again, now let me just take this down real quick and let's go down to the daily. It may feel like a crash because that's what that did, but it truly was very controlled. And then when we got down, we did 5 waves down. You saw the result. Friday's result was this market reaching a low, not breaking below on the SPX, not breaking below the 200 period simple moving average. So it held and it launched. Now, there was a cry that the market is extremely oversold. Well, I wouldn't call it extreme, but it was. It was at that low oversold. Well, that was all it really took. Plus, it was an expiration. It was a Friday expiration. Plus, we saw, and you can go and you'll find it. I just want to show you, if we look into the VIX, this I heard about on Friday. One trader, one trading firm trader came in and bought 50,000 October, which the expiration on the October 18th, which is a week from Wednesday. On October the 18th, bought 50,000 of the October 25 calls. Now, a lot more people joined him in that party, right? Because we see that that's the highest interest, highest open interest, and more than 50,000 traded. Now, if you were the dealer on that side and you're making the markets in this thing and somebody comes in to buy 50,000 and you sell 50,000, you're selling volatility. You're selling index volatility. What happens? What are you going to do with all that newfound money that you're just now taking in? You're going to have to put it to work. You're going to have to hedge it. You're going to have to do something. And what did they do? They turned around, they bought underlying volatility. That is what it appeared to me. So it was a reigniting of the dispersion trade. Now, don't forget that the day before, as we were coming down last week, volatility, as measured by the VIX future, popped over 20. So that kind of drew more money to be sold. More sellers came in. But once it stopped, you notice, oh, okay, what's happening now? So we're going to sell that volatility, take that money, and go back and put it in the components. And that's exactly what we saw. And it came in triple time on Friday. So if the market really did this on Thursday, then so a lot of that hedging took place on Friday. We did see some of it on Thursday into the close, but it came strongly. And my thought process is that it actually was likely pre-planned, right? The number came out. The market did a nosedive, went down and equaled that low, did not break, but equaled that low, and then launched off of it without looking back. So what we ended up seeing is something that, in my view, is not likely sustainable and likely will be reversed. Now, let's just combine that with what we also saw. We saw in the Treasury markets an immediate destructive slide to new lows in the futures markets and new highs in the yield. So for the 30-year bond and the 30-year yield, it popped above 5%. 30-year bond at 5%. Now, granted that I will share with you that within the Treasury markets, we're seeing an attempt being made to narrow that inverted curve. So, and what that suggests is that the long end of the curve, rates are going up, while the short end of the curve, rates are kind of being stabilized and being pushed down a little bit. They're trying to get that inversion where short end is higher, paying higher interest than long end. So they're trying to get that evened out just a little bit for whatever the reason is, that does seem, and it stayed in place. Well, we can look at the 2-year note, we can look at the 5-year note and realize they're not tumbling as hard as the 10-year note and the 30-year bond. They got hammered. Then they recovered. And they recovered strongly off of the lows that they made on Friday morning, and then sold off again a little bit into the close. So there's much afoot in the interest rate markets. And to try to explain is a very, very lengthy conversation, because we're really going to go into what is happening, what is really the function of the Fed, and what is the Fed doing, and what is the Treasury doing, and how are these things combining, and who's holding the bag. So in other words, it's like when I sit there and look at the Fed's raising interest rates and everybody's screaming because it's like, they're trying to fight inflation. It's like, don't forget, this is the same Fed and the same Treasury. Now, they need to get a bunch of stuff off of their sheets, right? Their balance sheet. So they need to take a lot back in. But if you shorted the bond, right, by selling at the low interest rates that we saw back in running up to 2020, and now Treasuries are getting nailed. So if you were the buyer of the bond there to get your 0.05%, a half a percentage point interest for the next 10 years or the next 5 years, or however long your term is, and you're watching that 10-year note price, because what you paid for them. And again, I'm going to go through this now because I think it's really important that we understand. So if we're going to go back, I got to go out a lot further than that. Let me go over to my here. Now, because we've got enough time, let me go out to here. Back in August of 2020, the 10-year note reached a low and yield at 0.69%, less than 1%. But when those buying that, they were paying $139 for the bond. That was the price of the bond, and that yields you that 0.69%. So you in essence gave your money to the Treasury or to the Fed, right? So you're lending them money and for the next 10 years, and they're paying you 0.69%. So as that 69%, not a lot of protection. And look what happened. Now the bonds are dropping. You're still long at 140, let's say. Now the bonds are trading at 120. Now the bonds are trading on a low. On Friday, they traded as low as 106. Those are huge losses. So what are we seeing? Well, if I was the Fed, or if I was the Treasury, you're looking to buy those back. Boy, I'll take them off your hands. And you're selling them with a yield of 8 point or whatever, 5 point, 4 point, whatever. But I hope you're getting the picture. And this is what's turning. So the Fed continues its battle to fight inflation. It has a goal. It wants to see 2% inflation, and they want to manage it right there. But in the meantime, Treasuries are getting nailed. And they still look as if they will need some additional declines. So we got to put this all in our picture. So that is what is going to contribute to the continued decline. But I'm looking for a primary C wave, an intermediate, a cycle A wave. And then, as I have been talking, I don't consider that a crash. A crash would be similar to 1929. A crash, yes, and in 1989, the market crashed in October because it dropped 500%. So yes, if we're going to see an intermediate third wave, and I'll get into that in a second about where we are inside that intermediate third wave, what really would come next is a minor third. So we're getting ready to go back into that 3 of 3 type of a move. Now, you've heard me talk about it on the way down initially, right? So, but that I thought would have been in the minor third. And so let me go down to the daily. Let's just jump right into what we're going on here. So by me changing to the intermediate degree here, that puts us inside an intermediate third wave decline. Now, within that intermediate third wave decline, what we're going to get is 5 waves of minor degree. And before you get excited about saying, well, you changed your mind, you just change it on the fly. No, I didn't change it on the fly. I discussed it previously. And always, 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 you must allow the market to tell you. Part of why I made the change is we did 5 down. We did 5 down, and that kind of put us into the position of, well, then if this is a minor third, we're getting a minor fourth wave, and already, right? So this would be minor 1, this would have been minor 2, minor 3. Minor 1 bottomed at 43.35. Minor 4, this is what this would be under the previous labeling, reached a high on Friday at 43.24. Now, unless we're not expecting one more point of rally, the wave 4 would be invalidated if it broke above 43.35. That's the primary reason I went and got, okay, this is intermediate 1, intermediate wave 2, and we're building. And I base that also on the fact of what I do see happening and how money is shifting itself around and what really starts to come next as the great unwind continues. So, minor wave 1, 1, 2, 3, 4, 5. Look at that. They're gorgeous. The other thing that I actually made a change on as I went from candles over to bar. So we still get to see the extremes, but the moves themselves are much cleaner to see than if I'm trying to follow this on a candlestick chart. Now, for my day-to-day trading, I definitely will use a candlestick chart because it's a whole different aspect of why I'm using them. But in terms of analyzing the market on a larger time frame, the bar chart really does the trick, and it's very clean. And we can see it all the way up. We can see it coming back down. I don't get all these extremes running back and forth. I see the exact really what was happening. And so here we have 5, here we have 3, here we have 5. Now, one of the things that really would have been if I had left it as minor 1, minor 2, would have been had to shift possibly to an ABC, and you're going to be putting a 4 down here. That goes back to an older, but then that did not necessarily fit with what I see coming. What kind of catalyst other than earnings would we see to propel a market to move closer to 45, 41 basis the SPX basis cash or higher? When we're talking about, and the reality is like, yes, interest rates have gone up. Bonds, by the way, they've lost 46%. Interest rates have now gone up in terms of percentages, in terms of where they started. This is history here, folks, what we're seeing. And so these large moves, yes, they're going to come to an end. Yes, there will be a period of reverse, so to speak. And that's what I'm talking about here. So I'm looking for the larger move to get us down to these levels down here, actually a little bit lower. Down in here to here, that's my zone for primary C cycle A. And as I will continue to tell you, what comes next is a cycle B wave counter trend rally. Now, that's going to be a counter trend rally in bond price, in the equity market price. And what's going to really fuel that is that we will get into a period where things will shift and we will see a return. So the other thing that I want to bring up here is through all of this wrangling, all of this injection of money into the markets, and now there's a lot of that money is being moved out and is sitting in money market funds. Why? Well, because I can earn 5% on my money market fund. Well, I don't need to leave it exposed in the market. I'm going to sit it over there. What is it then considered? It's money on the sidelines. If you're really kind of concerned about the market and direction, then okay, if I've been long and I've made some decent money, I'm going to get out and I'm just going to sit it over here and wait. Because I do believe that the markets will come down. I do believe that we're going to reach a low, whether that and on an Elliott basis, a low for cycle wave A. And I'm going to get that moment where I will want to move back into equities. I'm going to want to move back into bonds. Bond price will go through its own B wave counter trend rally. And if I'm considering that the 30-year bond is sitting somewhere around 108 and has the potential to drop down to 106, and it can go back to 145. I don't know exactly because I have not been able to measure it. I need the low. But we're going to get a rally. We're going to get a rally. So again, now confining into, is it all over then? Is then that we're going to go and we're going to start this new economic expansion? My answer is no. Because what is still out there waiting is a cycle C wave, which is going to make this cycle A wave look like kids play. So I think the real destructive crashes and the real destructive, the massive interest rate hikes, the periods of, we go into a recession, the periods of deflation, which is nothing more than just readjusting the overinflated prices we now have in our equity markets. Nothing is sustainable. Nothing goes on forever. Adjustments will be made whether we like it or whether we don't. Situations will occur. They will happen. But right now, folks, we have to remember, we have catalysts that still are in place now that the former president and the former administration put into place. Those tax cuts that they gave corporations and the higher 1% are not due to expire until 2025. Where am I looking for this wave C to really come in? 2025. Where do I think that we're likely going to get to that low of super cycle wave 4? 2025/2026. Now I did I can show you the whole thing, but again, you need to be able to attach the fibs to it. But in terms of just everything rolling out, and again, this is the big picture technical update. I see us coming down, and there are going to be plenty of catalysts that are going to drive it. By the way, I'm sure we're all aware because we all watch the news. There's now a declared war between Israel and Hamas. That could spread easily. There is a renewed Russian advances into the war that it has declared on the Ukraine. Things are heating up and they're very destructive. Now, what's going to get interrupted if Israel's really going to be at a prolonged war with Hamas on the southern border and maybe has Hezbollah on the northern border? And who's behind it? We're not going to go into that whole thing because it's not a part of really a market technical discussion. But if you're looking for what could really come up and rock the boat, that's one thing. What could come up and rock the boat? Well, interest rates. That's another thing. What can come up and rock the boat? Inflation. Problems within our country. Wage inflation. Major topic right now. We're just not paying attention. United Auto Workers on strike. The healthcare workers through Kaiser. That was only a 3-day strike, but 75,000 people. And they're not the only healthcare system that will go out on strike. That is looking for higher. Why? Because inflation, folks, the consumer inflation, we're all there. We know what we have to pay when we go to the grocery store, what we're paying for a gallon of gasoline, what we're paying across the board. Our prices aren't going down. There are people that probably earn a good salary, but they're having trouble making their ends meet. Again, so these are the things that we need to kind of look at what's going to come in and interrupt our boat. Because if we have to go on what we did on Friday, I'm going to come down to my 4-hour chart now and get back to these technicals. That was incredible. And that rally was incredible. Now, I know that there was some, and they actually were honest enough to talk about that they got caught. And they watched their account drop by a large sum of money. I'm sorry that happened. So what we need to kind of participate in is being able to flip on a dime almost and protect. If we're short and we don't necessarily want to get out of the short, we better protect it. So you have to be able to trade while you're holding that short. As a day trader, it was glorious. It turned into one of those, because I saw the dispersion trade in force, right? Dispersion trade, selling volatility in the volatility index, so selling the VIX, and buying underlying volatility, component company volatility. And we saw that. We saw them do that. And we saw the reaction, what happened. Equity went up, equity prices went up, and we had this massive rally. Pullbacks were almost non-existent. They were nothing but just on Friday. Can't speak for tomorrow, but on Friday, they were nothing more than just buy it. Just buy it, let it ride a little bit, put another contract on, manage your risk, and then just let it go up, because that's exactly what it did all day long. So again, as a day trader, plenty to do. In fact, it was boring because you just had to sit and wait and then take that off, or leave, put your offer out there and then wait for it to kind of go up, because it didn't stop. And now, what is it on an Elliott basis? Again, the change, intermediate 1, intermediate wave 2. We're in an intermediate third wave. It consists of 5 waves of minor degree. We finished minor wave 1 on Friday. So we have, that would have been on the 3rd. So we finished that in the SPX on the 3rd. Let me see what that low is. Let me make sure I'm not talking off the top of my head. 42.1645, and this one was 42.1955. So yeah, we finished it, and then we started right A, B, C. So I'm looking for a wave 2 now. Okay, now let's go back and talk Elliott for a minute and talk Fibonacci. So what most common for a wave 2 is going to be 50 to 62%. That's up here. So we do have potential for additional rally. We have potential to take us to 43.80 basis the cash market now, and 44.77, 44.17. But in the way, we have the 100 simple moving average at 43.94. And we have the 200 simple moving average at 44.44. So we've kind of got a range in here that likely we're going to see this ABC finish up. Now, what am I looking for immediately here? Well, if I got an ABC and I'm going to put an A there, or is it going to go 1, 2, 3, 4, 5, and I'm going to have a 5-wave A, come down in 3, go back up in 5, and end up still somewhere up in here. Remember, a wave 2 can retrace nearly all of wave 1. It just can't exceed it. So we could end up back around 4,500 before all is said and done in a minor wave 2. What does that then lead to? A minor third wave. And that's going to be, again, I'm going to discuss with you, wave 3 of 3. And so we're going to get in again to another point like we did in here. Again, I was thinking it was a minor third. So I was thinking it's wave 3 of 3. Minute wave 3 of minor wave 3. Now it is again going to be minor wave 3 of intermediate wave 3, and then within that 3 we're going to get a minute wave 3 of minor 3 of intermediate 3. So we will have that 3 of 3 of 3, and what that is, what I call, is the point of recognition. That is where the market will realize, holy crap, we are going to go down. We're not going to be rescued by this, whatever's going to happen. We are going down, and there will be something that will provide us the catalyst for it to drive it. So it will come through. I can't tell you what it's going to be, but I can tell you what the wave pattern is telling me. And again, making the adjustments to the count fits to that longer term picture that I'm looking for a primary C wave to bring me down to here. Now, this was 9 months. Okay, so 9 months from, let's call it August, takes us into 2024 before I'm seeing, excuse me, before I'd be seeing these levels. So we got a lot of time going on here. In fact, I believe that the interest rate markets, the treasuries, will begin their counter trend rally while the equity markets have continuing decline. And that is going to be a function of deflation. So we got so much going on. And it's going to happen all behind the scenes, and it's just all going to kind of filter through. But the wave pattern is suggesting what I'm talking about. So let me drop this down to the hourly. Let's take a look, right? So we have this very clean A, B, and this is a C. So there's really two things. I got to be honest with you. There's really two things. It's either going to work itself out. So I can see inside here, it shouldn't be a 5-wave. C wave should be 5. But the pattern itself, it's 3 up, 3 down, A, B with a C. So what do we got? Well, we got 43.40. And then it could maybe eke its way up to here. Now, is that then just going to be completing wave A? My gut says, yeah, I think it will, but it may not. So in other words, if we kind of get some follow through that gets us up closer to that 50% number, and that could come tomorrow, it could come in Globex. Again, we're going to be, a lot of people might sit and look, go like, how could you guys buy this market up? Israel's going to war. This is getting worse. This is happening. That's happening. Well, same thing occurred on Friday. So what's to say it can't occur again? My point being, I'm looking for a wave 2, and here are our markers, and here are the moving averages. Now, we're getting ready for the 20 to cross the 100. The simple moving average there, if it does that, it should give a boost. just like it did here when it broke the 50 SMA. It broke the 20, then it broke the 50, and ba-boom, it took off when it stopped, broke the 100. It got some legs again. Small decline, legs, small decline into the close. So is it truly just a 1, 2, 3, 4? We still have a fifth wave? Possible. I mean, you can just keep bringing it down, and we're going to take a look inside. And I'm telling you, I'm not really, this is what I was talking about. You don't really see too many pullbacks, right? So I'm going down to the 15-minute chart. 1, 2, 3, 4, 5. So it could be it. And what it would show me, if it is, what it would show me is that there's underlying weakness in the market for whatever reason needs to be attached. So what we don't want to do is we don't want to get so attached to, oh, everything's bullish now. Look what they did. They bought up Apple. They bought this, because we're moving into earnings, and earnings are supposed to be the greatest thing since sliced bread. That's on one side. And you got the other side saying eventually higher interest rates are going to chip away at corporate earnings. Well, that got buried with, oh, earnings are going to be great. Look at what they're doing. They're getting ready for those earnings. This is Friday. But we had on Friday an expiration. And if you just did a run through the gamut of the Magnificent Seven, you already got the heads up that in Apple, it was at least going to be 175, if not higher, which it did end up being. And you could go down that list. Google was going to be 135 or higher. Meta was going to be 310 or higher. Microsoft is going to be 325 or higher. So we just continue to look over this list to see where they were going to close, and they did. NVIDIA, right? It was at least going to be 450 or higher. They gave it a one last final shot to try to get it to 460. Again, you know, as a trader, I keep an eye on that. And it's nothing. I'm not saying anything about am I bullish or bearish. I'm talking about this is where they're going to pin it, because that's where the options positions are lying. Again, I'm going to tell you, so much happens without any conversation about are you bullish or bearish. It's all about the number. It's all about what's trading. It's all about volatility. It's all about premium when you're dealing in options. So again, putting that all together, boom, you get this magnificent rally, which presents its own opportunities to us as traders, but is likely going to be very limited because the larger picture continues to suggest we have a lot more downside to do. So I'm looking for the completion of this wave 2. Now this is the SPX. Here are our levels in the cash market: 43.40, 43.80, 44.20. I'm rounding them up. You can go over to the ES, and it's going to show the same thing. Right, got the 1, ding, 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 2, right? So this could be wave 1, excuse me, A, ding, 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 B, and we're in the C wave. I would be expecting some additional upside tomorrow or later today when Globex opened. So we're looking at 43.75, 44.20, and 44.60. Remember, wave 2 can retrace almost 100% of wave 1, which brings us up to 45.98. Just cannot exceed it. So it can't exceed 45.98, because if it does, it's no longer a wave 2. Then it's going to be something else. I don't think that that's what's going to happen. Again, looking for that. And then minor wave 2, we're at a minor third. And I would expect it to kick off pretty much like we have seen in the past. Bam, ding, ding, bam. A lot of fight, but we get the moves. Okay, so it's in the S&P. Now, S&P, let's take a look at the daily, because that's where I kind of monitor our moving averages. So right now, let's look at that daily. You can see what we did. This is the 200 period simple moving average. When we broke it, bam. When we retook it, I got a little bit of a flurry. What's up next? Well, now we got to get across and go above the daily 20. That's going to be resistance for right now. But where is it sitting? 43.82, 43.83. A break above is going to give a boost. And then we maybe get to 44.16, 44.17, up to 44.20. But then what do we got? We have the 100 period simple moving average sitting right here at 44.64, I think it was, 68. So if we get above 59, it's going to probably try to get there, with 44.81 being above. But guess what? 618, 44.60. So I'm looking for these moving averages to really cap it. That's on the daily chart, right? So I think that they will provide enough resistance. We can get the wave 2 in, and we get a turn. And we get that wave 3. Once that's in, these are wave 3, right? This is the third. So 100%, it already did. 1.618, which is the next one up, is 41.30. I think we're going to get more than that. I think we get down into here, because now I'm looking for that C wave to kind of start ringing its bells as we progress in the intermediate third wave. So I'm looking for intermediate wave 3 to finish up somewhere down in here. Well, that we're at 43.45. That's 700 S&P points down, 670 down. That's a lot. What's going to drive it? We'll see. We will see what will drive it. So many things going on. Okay, over to the NDX. I don't have to give a lot of the background here, right? So now I'm just going to really keep it in the technical. Thank you for hanging in with me while I really went on to fill in a lot of the blanks that go behind the technical picture, which help to create the technical picture. Same thing in the NASDAQ. I'm looking for primary C wave down. Primary C wave, C would equal A at 96.07. Where am I looking for? Where am I looking at that? Well, we're in October of 2023. I'm looking first quarter of 2024, or maybe even a little bit later, right? Because what we say, July. So if we're really looking at August, and we have four, and then 4, I'm looking April. So I'm looking into April of 2024 for that 9-month marker, the 9-month marker, April, May of 2024, for the NASDAQ to kind of be sitting down in here. We got a lot of trading in between then and now, or now and then, I should say. So same deal. But in this case, in the NDX, I've kind of left it up as that, and I should have changed it. Please forgive me. I did one and forgot to do the other. So this is going to give me 1 second while I do that. So I apologize for that looking rather confusing. And sometimes I don't even follow my own work to make sure that I've got everything in there as it should be. So this is going to be wave 2. It's not anything major. I just got to make this one little switch. I get everything else set up and just forgot to change that. But this one makes it even clearer, on how close it was to just invalidating itself. So, and then put that like that, put this here, put that there, and italics. Okay, bing. All right, so same deal. On the daily we are. Whoops, come on. So 1, 2, 3, 4, 5. It's not as clean as in the S&P, but it is 5. And so that is going to be minor wave 1. These have up to intermediate wave 1 and 2. We're now looking for intermediate wave 3, which is now in process. We're into a minor wave 2. It was a magnificent turnaround. Let's take a look really quick at our moving averages. So what we've done is that there's the 100 simple moving average never really declined. It continued to point upwards along with the 200 all through that decline, which kept a lot of things alive, which kept the rally, intensity very much alive. Coming into there, we were not oversold. They screamed that we were. They screamed that these stocks were oversold because they needed some people to come back in and go jump, and they did. So in other words, I don't believe in the oversold here. But we got the rally nonetheless, and it was strong, and it was basically strong right off of the lows that we saw back in the end of September. So October's been pretty strong in the NASDAQ, but the count itself remains the same. So going down to the 4-hour, it cleans up a lot in terms of like, boy, when's this wave 3 going to kick in? When's this wave 3 going to kick in? It's going to. That much I'll tell you under how I've got it counted now, it will. So we're looking for this minor wave 2, and I need to switch. This is for there, and this is actually, let me see what this one is. 0.50 and 0.2. Where is, oh, here they are. There's the 50. 50 and the 618. That's for the rise, the rally. Backers 382 is already gone. So to tell you the truth, I put my fibs up, but I didn't change my labeling. So we've already gone through the 382. So what we have left, 50% at 15,026. But then again, we've got the, I want to do this. Hold on. Open it up, bring it back down, open it up some more so we can take a look inside. We have the 100 at 15,057. We've got a fib at 15,025. And then we have more resistance right now because you can see how it's going flat at 15,057, going above all that. So here it's a little bit cleaner on 1, 2, 3, right? So A, B, 1, 2, 3, 4. A 5. So this 2 is going to complete hopefully at the same time as the S&P, because I would not, this is a much different pattern. It still could be an ABC and we get a B wave, so it could be ABC A, but it's, see the size is kind of, could be A, B, and we're in the C, and that's going to complete the 2. It's going to be a little bit different than the S&P because the S&P could either be showing the weakness, as I described, or it's going to jump a little bit harder than the NASDAQ, which I don't necessarily see. So either we're going to get this push stronger here, and that's going to take us up to 618. So we have the 200, and then we have the, the 100, then the 200 at 15,193. We've got a fib at 15,165. So we have zone 1, we have zone 2. A break there will jump this up to 15,500 because that's my price points. I got some at 15,270, some more, 15,400, et cetera, et cetera. But ultimately, we can start getting up to 15,500. What it can't do, it can't go above 15,620 because that's the top or the starting point for wave 1. Now, here again, ABC, minor 4. I don't necessarily see that. I think that ship has sailed. I think there's too much sitting outside of all this. They may try to play this game and push all of these Magnificent 7, but I think they get caught up in their own stuff. Again, I'm kind of looking for the NDX to get up to there. Now, what's it going to look like in the NASDAQ? Do I have to go over and do the same thing in the NASDAQ? I do. My apologies, folks. I thought I had this all done before I started, but I spent so much time on the S&P. So my apologies on this one. Put these together real quickly. I think everything else is in alignment. So, and now you can see I actually do it all by hand. I don't count on anything other than my own hand to label my charts or to actually work my counts. So a lot of them use artificial intelligence. All right, so here we are, 4-hour chart. Let's open it up. So again, intermediate wave 1, intermediate wave 2, and minor wave 1 completing right there. So again, This one's a little bit different, right? So this one looks like we got a 1, 2, 3, 4, 5 for wave A, and then an ABC for wave B. And then 1, 2, 3, 4, 5. So this, again, like it was showing us in the cash market, looks like it is ready. And the zigzag fits cleanly because we got 5 for A. So it's a 5, 3, 5. And that then should complete the minor wave 2. So same targets. We can see that we've already here within the futures market, we popped above the 4-hour 100 simple moving average. And we popped above the 50. You could see it happened there. And boy, did we explode on that one. And the 20, and we gave more. And then we got a little bit of a boost on the 100. Now we got the 200 up here. It likely will give it a boost, but I think we start to run into a little bit of resistance up there at 15,365 area. We have additional all the way up at 15,700. And again, depending on how hard they want to push. But I think what we have now is maybe, again, volatility starting to reverse out a little bit. I would think, as we get actually closer to. Now, I will share with you, I would not be basing all of the earnings reports on if the banks come out and show stellar earnings again. Understand the workings of the bank. Understand how much money they're making off of the moves in interest rates. Understand how much they make via trading, and they're not just necessarily holding long. That's what continues to propel the banks. They have all of our money, and they must put it to use, and that's what they do. So they're trading, as we should be. So I wouldn't base that earnings, oh, the banks have done well, that means everybody else is going to do well. Don't count on it. In any case, I'm looking for this to kind of come up here. I think I just did if I look at the daily, on the daily, see we have, again, the 100 period simple moving average at 15,261. This is the daily, so it's going to be different than that 4-hour, of course. And then we have the daily 250 moving average, simple, at 15,332. So those I'm expecting to provide some resistance and stop us. Maybe getting up to 365-ish. But I think it slows it down and provides some resistance, and we get our turn. Right? So remember what comes next. Minor wave 2, we got a minor wave 3, which will unfold in 5 waves of minute degree. So we will get to that 3 of 3 of 3, that point of recognition. Yet to happen. It's out there. Yet to happen. All right. So I am going to complete this right here. This has been long enough. Thank you for your spending part of your Sunday with me and catching up on all of this. And the next Elliott Wave update will be on Monday, October the 9th.